Good morning to everyone. Today we are going to discuss the corporate finance and risk management concepts and how it related to your pre-scene. I think you have gone through your pre-scene uh, yesterday, and I assume that you have gone through few at least minimum 2-3 times through the pre-scene. Uh, with having that idea while reading, then you might have note down and sometimes you might have analyzed. I have seen some students already analyze the pre-scene into the detail. Uh, this is a kind of a 2020 match. I will tell why I have told at the inception. I am Nishant Adhikari. Today I am the person who's conducting this session. Right. Without wasting any time, we will start the session. Okay, financial management and financial and risk management area. We need to cover 20% of the syllabus content. Simply the areas you can divide into two. One is financial feasibility and funding section, and other section we call risk management section. Those are the two broad areas which we need to discuss under financial management. I think you have gone through these areas, and today I'm going to brief about the concepts, key areas which you need to focus on. And remember, you have this final examination, you have to dig into the deep, right? Like deep diving is required and you need to analyze in depth. Right. I am roughly going through. I will give some hints. Then you should analyze because within 3 hours, 4 hours, we may not be covered all the aspect, but I will highlight these are the areas which you need to focus on. Right. In the first step, financial feasibility and funding, simply the syllabus structure. If I tell about the syllabus structure, when we see about the financial feasibility and funding, sometimes there are situations like last time also. They have been provided the situation and you have to evaluate the position or options. Sometimes it might be an NPV computation, it might be an IRR computation, it might be payback period computation, or sometimes it might be a valuation technique, or sometimes you are going to acquire another company, you are going to establish, or you are going to have a going to issue a IP or not IPO, we are going to list and you need to value your own business. You have to do some valuation and you have to evaluate the scenario based analysis. You have to perform. Then you have based on the recommendation, assume if you are going through with the project, then you have to suggest suitable financing option, either whether it is suitable good time to go for an IPO or you are going for, if it is a private limited company now, uh, the CHL Centric Holding Limited, they are also a private limited company. Then when we are going to raise the fund, there are two methods of raising funds, equity financing or debt financing. I think you may already aware about it. Then you have to recommend what is the suitable funding strategy, that is financing strategy, based on the current status of the market, based on the company operation, based on company gearing situation, and prospect borrowing rates and the market condition prevailing in the time. Those are the consideration you have to consider when you're going to recommend suitable financing strategy, right? Then I have briefly explained. This section covers 20, 20 marks. That means out of 80, 20 marks will be given for the financial management. Business and corporate strategy, both two section 45 marks, then this one 20, 65. Taxation 10 marks, 75, and 80 marks will balance 5%, governance and ethics. Those are the subject fillers. So those are the areas you need to discuss in deep, right? Then the first section I have, as I have mentioned, we have to deal with financial feasibility and funding. Then risk management aspect. In this environment, risk management is a key because our external environment highly volatile. In a volatile environment, The risk management is essential. It should be proactive, not reactive, because now you can see the external environment forces. External environment is rapidly changing, and the industry currently we are going to discuss also hot topic of the town. That means it's a very essential topic since we are running through a power crisis or energy crisis, right? That is why this is a very good uh, discussion. If you have any question at the end of the session, I will give you some time to have some chat and we will have some discussion, right? I think I am audible and this is more, I want to do this one as a more interactive session, right? Uh, well, first important topic is capital budgeting. The reason is if you have, I don't know whether you have gone through the past papers, past case study examination paper. This is a one of important topic which we need to discuss under financial budgeting or financial risk, financial management. Capital budgeting. Capital budgeting means simply you can say project appraisal, right? Or investment appraisal. While I am not going to, now you need to read this pre-scene. In the pre-scene itself, there are some hint about the proposals. You need to evaluate them and you have to make a decision. I can remember one paper, they are going for online footwear business. I can remember in 2017. It has not asked a big computation. It just asked to calculate payback period, because their target payback period was, as I can remember, 4 years. You need to decide whether your target payback period is 4 years or less, right? Therefore, capital budgeting, it is sometime it might be acquisition of a new equipment. You are going to do a long-term investment. Assume you are, if you're going to invest in a long-term project, you have to evaluate the cash flows. Then you have to calculate present value, sometime payback period, IRR, profitability index if the investment is different. Those capital budgeting concept you need to learn more. I think these capital budgeting concept you have learned in advanced management accounting in corporate level and strategic level also financial management section you might have learned. Right. Now these are the techniques given: payback period, discounted payback period, net present value, accounting rate of return, internal rate of return, profitability index. Right. Okay, payback period. Now you need to remember the things you have already learned. If the payback period measures the time in which the initial cash flow is returned by the project, that means once you make an investment, how long it will take to recover your initial investment, how long it will take to. This payback period approach is a risk aversion approach. I will take risk aversion. You will tend to invest in a project which will give you the immediate return. That means you will not look at about the long-term effect. You will consider long-term effect, but you will try to recover your initial investment immediately. That means you are preferring lower payback period. Immediately you are trying to recover your immediate initial investment you have made. Remember, it might be discounted payback period, it might be normal payback period. Net present value, but remember in payback period, we will consider the cash flows up to recovery of the initial investment. Therefore, subsequent cash flows will not be considered. It will be ignored, right? That is a one of weakness. Sometimes entire whole life of the project will not be considered. It will be negatively affected. Some decision might be wrong. The net present value technique is a widely used concept. You will consider entire lifetime of the project or investment, and you will look at what is the present value. Okay, after discounting based on your cost of capital, you will look at net present value, right? Present value of future inflows and outflows. Generally, if the NPV is positive, you can go ahead with the investment, and if you have multiple projects, you will select the highest project which gives the highest NPV. condition there. If the different, initial investments are different and mutual exclusive project, when you're going to make a decision, you can use profitability index to determine which is the most suitable investment, right? Accounting rate of return, it is very easy to find out. You can calculate initial investment will be there and net profit, accounting profit will be considered when determining the uh, accounting rate of return. Remember, this is a non-discounted, sometimes it is the non-cash flow technique. Why I am saying non-cash flow, accounting profit contain depreciation and other estimates. IRR, that means it is a extension of NPV. Once you compute NPV, if it is positive, you need to see what is the maximum limit which I can borrow or which the cost of capital go up. You have to find out the indifference point. That is the project which NPV equal to 0. That means neither accept or reject can be. That is the indifference point. What is the maximum rate of borrowing or maximum rate of cost of capital which your NPV equal to 0. Right. These are some techniques which I need to highlight when we are going to discuss this capital budgeting. Right. I think you have understood it. Okay, another important concept, use of terminal value. Generally, sometimes when we are calculating a project, generally it will provide 5-year or 6-year cash flows or some operating cash flow. Sometimes it will be the profit before tax or whatever the information will be provided. But sometimes, if assume you are going to acquire a business, the period beyond the given stipulated time, assume 5 years, beyond 5 years, then it will say beyond 5 years, the cash flows will grow up by 3% till uncertainty. It will continue further. Then you have to calculate the cash flows beyond 5 years. What is the present value? Then you can use the present value, calculate the terminal value calculation to determine the terminal value. Because most of the cases, you might have to determine the terminal value, right? Terminal value calculation was there. You have to determine it and calculate what is the value of the cash flow, present value of the cash flows beyond the stipulated time. Okay. Therefore, this is how it will come. This is the free cash flow technique. If you calculate the terminal value of free cash flow into 1 plus, this is a model, similar model. We call dividend growth model when we calculate, estimate the price. This is the way of applying dividend growth model. Free cash flow into 1 plus G, simply we call D0 into 1 plus G, D1 divided by WACC minus G, or in dividend growth model what we have done, KE minus G, cost of equity minus growth rate. That's how we have calculated the terminal value of the cash flows, right? I think, I don't know whether I am too speed up. I don't know about that. I am just continuing the session, expecting that you have clearly understood the concepts, right? If you have any question, you can raise the hand, then I will attend, or you can put into the chat. I will reply to the chat, or I will explain if you have not understood in concept. Right, hope everything is okay. Then I will move to the next concept, financing strategies. As I have mentioned, once you have done, right, once you have done with the appraisal, assume it says financially feasible. If it is financially feasible, then you need to determine suitable financing strategy. Okay, first, before going to this financing option, you can raise your hand, or you can let me know how many of you have already read this piece in minimum 2 times. I'm telling minimum 2 times. Just few has done this thing. You has done. Thank you, guys. Yeah, the familiar faces are there, some family names, because I know that they have done it. Okay, thank you. Thank you. Right. Because it is very important. Now you can lower your hand. I know that people, there are close, 8, 9 people have done. Okay. Please mute your mic, guys. Please mute your mic. There are some people here. Okay. Right. Financing arrangement. Financing arrangement. One arrangement is scenarios while explaining the theory. Yeah. Now, what I have told, if you have properly read, there are some options. Now, when capital budgeting comes, I think if you have done some past paper scenarios, now it says do the evaluation, financial feasibility. Then if it says the financial feasibility, then you have to do whether it is feasible. You can either do NPV analysis. Sometimes they might specifically mention, do it and explain whether it is suitable or not. Now look at about your current situation in the financial analysis of the scenario. I will explain equity and debt finance. When you are being a private limited company, your growth will be limited because limited access to the capital market, right? Limited access to the capital market. If such situation, what you have to do in the pre-scene, while you are reading pre-scene, there were some hints. They are going for an IPO. Those are options if they have recommended. Okay, these need to be discussed in detail, but you can see there were some hints given in the pre-scene itself. If you're a private limited company, you can go for an IPO. Now you have to think about whether this is a suitable time to raise IPO, going for an IPO, right? Because in the market condition, most of the scenario now, if you look at about what is the all share price index at the moment, it is below 8,000. 6 months back, it was about 13,000. Now it has been fallen by 5,000 points. 13,000 fallen to below 8,000 now. Then this is it a good scenario to come? Can you remember the first recently in 2021, as I can remember, there were IPOs which were oversubscribed. First one of the Winforce. It is been oversubscribed. It's Aqua Brothers investment. Winforce PLC, thereafter Logics Leisure, thereafter Capital Alliance. Those are the companies they have come to the IPO market. They were oversubscribed recently. Exterminators, and there are Alpha also coming into the market. But nowadays, the Hella Clothing also it was dropped below their market issue price even now. There are some situations you need to analyze whether you are going for an IPO or what is the suitable option, or private, whether you will be able to take private equity through a private investor. That is a equity component, debt. Now, whether look at about whether this company can obtain bank loan. Look at about their gearing situation. Then you can recommend. That's why I told these are not just mere theories. You have to look at the financial position of the company and see whether what is the suitable financing option. To determine that, you can calculate gearing and look at the gearing situation. At the inception for the first para, if I want to show you, give me a second, I will show it to you. In the first para itself says about the, first page itself says about the company's inception, the operation at the inception. Okay, I will show it now. Now hope you can see the pre-scene. I think yesterday it has been done. If you look at this scenario, look at the immediate financial position of CEH consisted of equity capital with zero debt. That is at the inception. Then look at about what has happened subsequently and whether they have sufficient option access to the capital market or sufficient access to the financial. Consider obtaining new finances, right? Therefore, you can go through it and you, because if I say about how it related to the pre-scene while I'm reading this one, okay, you can note down, and within the given time period, I will be able to give directive, right? What I am doing once we have done this kind of session, we have an interactive session with the students on this situation, and we have some team discussion, then they will familiarize it. That's why I am highly emphasize that you need to have a team discussion, then it will enable you to give a deep understanding, right? Therefore, these are the financing strategies suggested. Now you can see the flow. What is the flow? First, you have to identify, there might be options. You have to evaluate the options, right? Sometimes cash flows and all. Then you have to evaluate if it is the option is possible, what are the suitable financing strategies to the entity. Now, centric holding limit, then you have to decide what is the current background situation. If someone who has already read the background and who have gone through the entire pre-scene, you will realize that what is the financing situation or their current operating or capital structure of the company. Based on that, you can suggest suitable financing strategy. Sometimes it will be equity, sometimes it might be debt. Then it will be both combination of debt and equity. But it can be changed like that. Right. It's done. Cost of capital. The cost of capital is an important concept. I think I have seen in the pre-scene also, they have made a evaluation of acquisition of trying to acquire another company called I am Club Farm Bio Club Hotel or I am Club Hotel. Then they have done some analysis. That is the cost of capital. It might be cost of equity, it might be cost of debt, it might be combination of weighted average cost of capital, right? Therefore, each of the investment, each of the cost of capital, consider three element. Even a bank, if you're going to bank loan, bank will evaluate risk-free rate. Okay, what is the risk-free rate that they can earn from money? What is the premium for business risk? And based on the financial situation, gearing situation, they will add some premium. Altogether, it will consist with the cost of capital. Risk-free rate, premium for business, and premium for financial risk. Therefore, whatever the financing arrangement, you can see risk-free rate return will be there. As an example, recently traded treasury bills and bonds. What are the rate at the moment? If anyone can have an imagine, what is the recent AWPLR average weighted prime lending rate? If you have well aware about the financial market, capital market, anyone can give me an answer? Yes, thank you. 21.31, that is 1 week before. Now it is 22 point, as I can remember, 22.4. 22.4 is the AWPLR. Right. Therefore, if you look at about the risk-free rate, then they will have premium. If you want to borrow, assume it's a business loan, minimum they will charge at least 26%, 27% based on the ratio. Now your credit cards also will be charged at the moment the rate is 30%. Right. Now you can get an understanding about external business environment, the cost of borrowing, the cost of investment. You have to look at about the opportunity cost of the investment. Therefore, cost of capital is the minimum capital requirement, minimum requirement they expect. The investor expect what is the minimum return. Based on that, you can calculate. Sometimes you will calculate cost of equity. Simply, I will take how to calculate cost of it. Sometimes you can use capital as a pricing model. Can you remember how you have computed it? This is what capital as a pricing model. The cost of equity is the rate of return investors on an equity investment in a firm. It includes risk-free rate, then market risk, and into risk premium. Based on this, you can calculate cost of equity. Now there's an illustration. You can give me the answer. Then small illustration, you can give me the answer for this situation, this particular illustration. $15.4. Is it 15.4? ABC company have a beta of 0.9. The expected market return of the market are 10%, and risk-free rate is 4%. Okay, risk-free rate is 4%. Risk-free rate is 4%. Risk-free rate 4%. Plus. Then beta factor 0.9. That means less than market. Normally market risk always says 1. Below 1 means you are a risk averse investor. Right. Then risk premium, market rate minus risk-free return. Market rate is 10%, right? Market rate at 10%. Risk-free rate is 4%. Then risk premium will be 6%. 6%. Then your answer should be 9.4%. 9.4%. This is your answer. This is the answer which we can calculate, because this is, you can look at past papers and see, because recently we had a discussion with the examiner, not examination, committee in the examination division. It says that students are spend less time to study, and the writing skill, especially in SL5 case studies, very weak. I'm just mentioning their comments, right? And other thing is the analyzing part. You are not analyzing and you are not reading, because reading is essential to pass this examination, and you have to get the full understanding of the pre-scene. That's very much important. Otherwise, you don't think this will be an easy exam, but it will be easy for the person who have committed more time to allocated more time for the study. You can't say I don't have much time. Everyone has in a difficult situations are there, but you have to manage the time, right? The next one about the gearing and ungearing situation. Geared and ungeared beta, they're similar to how to calculate asset beta and equity beta. If you are a asset beta composition, the unlevered beta firm determined by the type of business in which it and its operating leverage. It's called asset beta because it is determined by the assets owned by the firm. Based on that, you have to generally what you have to do. If you are a private limited company, you have the unlevered beta. Then you have to levered comparing same kind of debt to equity situation, and you have to compare it with the comparative entity, and you have to unlevered it and re-gear based on the gearing position. I have seen some papers, some examination papers, they have been tested like that. Then you can get an idea how these concepts are very important. Have you seen the similar concept, similar thing has done in the pre-scene itself? Have someone has seen it? I will show it to you. The pre-scene itself, it was discussed. Okay, in the pre-scene, I will show you what they have done. There's a analysis team. Can see they have given computation of ODP, risk-free rate 11.9, unlevered beta given is 1. Then levered beta mean based on the debt to equity position, you have converted this into levered beta. This is equity risk premium. Then you have determined the cost of equity. You can use capital asset pricing model, CAPM, risk-free rate into beta factor into market risk premium. Then you can calculate equity beta. Cost of debt after the taxation, then it is 8.85, and capital structure of CHL says 9 to 10. I will see. Then they have calculated weighted average cost of capital. Right. These concepts are regularly using. That's why I said they are very important. I don't know whether you have read those things. Therefore, gearing, ungearing beta, then based on the capital structure of the company, you have to determine the market risk. Right. Then the ratio analysis is very important. Doing through the ratio analysis, what you will have to do. Okay. In the ratio analysis will give you an basic understanding about the business operation and where it should generate, where it should goes, and you can I get a basic idea about the current business operation and their nature. Why I'm telling like that? Assume assume you are an investor. While you are evaluating financial position of the company, you will look at what is the net profit earned over the last years. What is the dividend they have paid? What is the earning per share they have generated over the period? What is the return on investment the investment will generate? Then you will analyze what is the pattern, whether it's a growing business, whether it is a already mature business, whether this is a dying business. You have to evaluate it, right? Based on that, you can evaluate the financial attractiveness of the business. There is a preliminary study, right? There are some profitability ratios. You can calculate return on capital employed, NP margin, GP margin. Then you realize that now even the financial information provided of CHL, also you can do this ratio analysis. See what has happened over the period, whether it has been gone up, whether it has been reduced, or whether they are maintaining the similar ratios. Give me a second. Sorry, for the disruption these days, we are facing some problem because I was run out of fuel. I'm searching for where the fuel stations are there. I know because those are the critical problem in these days. No, sorry for that. Anyway, we will back to the discussion. You will have to do your own calculation and see what are the important ratios, and then you can get an understanding. Can you remember? I think now some people has the experience in auditing sector. When you're going for an organization, initially what you will do as a junior, sometime when we are doing the audit planning, we will do analytical review. Have you heard? It is you can't say now I never heard it that because you have done the advanced auditing also. In that, right? In that, when we are going to discuss and assessing the risk of the or what are the areas we need to look at, then you can get a rough idea. As an example, while performing a variance analysis comparing the previous year figure with the current year figure, if you see some significant deviation from the last year figures, you will see why. You have to look at what are the reasons. Then some situation you will do the ratio analysis during current asset, current liability, that is liquidity situation. You will evaluate them and see what are the tendency, what is the current situation, what is the current liquidity situation. Then you will evaluate gearing situation, equity and debt composition, all you will evaluate. Why? In order to plan, you have to identify what are the areas which you may require more attention. Therefore, in profit, this ratio analysis is a critical in this scenario because financial information being provided, there are more financial informations are there. Sometimes you might feel there are so many directions are there where to go, right? Therefore, this ratio is very important. Profitability ratios, especially, you can look at return on capital employed or return on equity. You can calculate return on capital employed, both equity and debt. Then NP margin, GP margin, asset turnover, sorry, return on capital, asset turnover into profit margin. Those are the areas which you can discuss or work out. Then DuPont analysis, then this is a way of assessing your return on investment when there's no specific information given. This is the approach which you can, based on the available information, which you will be able to calculate ROI, right? One is known as yes. Oh, right. I will explain the risk-free rate. Generally, we are taking treasury bill bond rate as a risk-free rate. Then, based on the market uh, factor, fluctuation of market factors, and the treasury bill trading option, at the situation, it depends. Now, one student has sent me the details. Thank you for the recent rate changes. Weekly average went up to 22.11, that is 3rd June, and 10th June it was dropped up to 21.6, a minimal, and monthly average running at 20.49, 6-month average 11.45, because the average is AWPLR, because most of since I am weekly monitoring it, because our lending or borrowings are tied up with variable rate, that AWPLR plus premium. Then if it fluctuate, then it will be directly affect your borrowing cost. Now there's a tendency there was because the decision taken by the central bank, the interest rate went up. It went up to the top. Now I think this will be the maximum level. Don't know. My prediction is my prediction. Then we can't sustain at this level assume, can you run an operation? Can you run a business which will give you, assume your borrowing cost is around 25% or 26%. And whether any business will give you, there might be some business give you net profit margin of 26%. It is very difficult. After paying 26% uh, of the borrowing cost, what will remain? It is not sustainable business. Your profit will be deteriorating significantly. Therefore, you have to think about the current market condition and the capital structure of the company. Based on that, you can recommend the suitable financing strategy, right? The DuPont model also you can try and see, whether you can calculate what is the return on investment of this particular company, right? Based on that, you can determine return on investment, right? This is a DuPont model, the soft application. Then debt gearing ratios. Debt ratio, current and uncurrent liabilities, divided by current and uncurrent assets. Debt ratio, debt to equity, interest bearing net debts divided by shareholders fund, or simply value of debt divided by value of equity. Then simply if it is greater than 100, then it's we call highly geared, right? It will be highly geared. Or you can use another way to, you can calculate this gearing ratio, shareholders funds plus interest bearing borrowings, both together, that is capital employed, divide by debt. Then it should be fall below. If it is greater than 50%, then it will be considered as a highly geared situation, right? Therefore, this gearing situation you can analyze into the company CHL or the IM Club Hotel, right? Operating gearing, it's given contribution sales minus variable cost divided by profit before interest tax, right? That means it should be more than PBIT, profit before interest tax anyway, because you have to pay interest and tax. The contribution should be sufficient. If you have a higher gearing ratio, that means you have a good, proper operating leverage. That means asset will be able to generate more profit. Then interest cover, that means you can look at, there are some companies, their profit is insufficient to pay their interest. Okay. Now a situation like, think about Sri Lanka. Now we are facing a situation, even our revenue is not sufficient to pay the interest. Right. If you are unable to service the interest, if the profit generated by the company, profit before interest and tax, is not sufficient to pay the interest, then you are at a trouble. You will be in trouble. Right. It is very much important you to see that whether your operation will sufficient cash flows to pay interest and tax, or simply interest, because interest is deductible for tax purpose. Therefore, you have to see whether is it sufficient, right? Because these debt and gearing ratios are very important. You can work out them and see whether where the company is going on, where the company is heading towards. Liquidity ratios, you can calculate liquid ratios, current ratio, quick ratio, inventory days, receivable collection period, payable payment period. Thereafter, you can calculate cash operating cycle, that is a working capital cycle. These are some ratios you can evaluate your liquidity situation. It is very critical. Sometimes you might have invested in long-term assets while taking the short-term funding option. That is a mismatch. You have to see whether there are some such kind of situations there in the given pre-scene or not, right? Therefore, you have to evaluate whether it is there or whether it is acceptable in this scenario, right? You can let me know if you have any question. You can text to the chat and see. Yes. Right, thank you. Some students are sending me the message, the live updates they are sending. The movement of interest rate, you can simply go to a CBSL site, type CBSL rates and indicators, then click commercial bank lending and deposit rates. Then you can see the issue. You can give the date range. You can see past 6 weeks, 10 weeks, or 12 weeks, more month, the interest rate movement, the AWPLR movement, and the bond rate, bond selling rate, what are the rates, the bonds being traded, 8-year bond, 16, 12-year bond, as I can remember, 13-year bond was traded at 19%, as I can remember recently traded. Therefore, you can get an idea about the how capital market behave. Now, simply I will explain. In this situation is a situation where encouraging investment or reducing investment, whether it is the policies taken by the government is expansion or whether it is kind narrowing down the economic activities. If you look at about their interest rate and all, now people are willing to make an investment in new businesses? No. If they have the savings, what they will do, if they have money, they will put into the savings or FD or treasury bills or treasury bonds, they will invest. Then when you increase the savings, can you remember we have learned in economics income approach, expenditure approach, withdrawal, and when we calculating the market stability of GDP, right? Then when the savings are higher, the economic activities will be narrowed down. The situation is currently look like that. Economic activities will curtail. Now we are in narrowing down the economic activities. Then disposable income of the majority of people will reduce. Then it will affect to the demand. When the demand reduces, the all economic activities will narrow it down. Right. You have to have that kind of idea about the external environment. Now, even if someone asks, what are you going to invest in a new house, construct a new house? Oh, this is not a suitable situation. Why? Because when you obtain a bank borrowing, or if you're going to invest your own savings, then the opportunity cost is very much higher. In the financial management individual, you can think, I'm thinking, I am suggesting, if you are trying to fix you can put a fixed deposit and fix it for 3-4 years at the prevailing rate. You will get benefited when it is start to fall. The rates will start to fall. Definitely, they can't come into the top. They will coming down. Okay, they have to come down. When it come down, but you have fixed your rate, then what you have to do, you will earn a higher return later, right? This is very important ratios, liquidity ratios you have to go into. The investor ratios, which most of the investors are looking at, right? Dividend yield, what is the dividend yield per share, market price per share, and what is the dividend you have received as a dividend yield. Now you can see about the CHL, when it comes to the CHL, how it will important, right? Because this is a huge case, okay? Because it requires more analysis. There are 21-page document. You need to each and every word you need to read and see. Now dividend yield, if you look at about CHL, there were some directors who are unhappy about the zero dividend policy. Then there are some hints. Yeah, that's why while you are reading, because I have read twice. That's why I can remember the things. Again, I will read 3, 4, 5 times. Then even in the dreams, I will memorize what are the things in the precinct. Right. Up to that extent, you need to go. Then whatever the question they ask, you will be able to easily tackle the situation. Price earning ratio, what is the earning per share? And then you based on that. Now, if you look at about the price earning ratio of if you look at about the share market, there are some companies, the price earning ratio, earning per share assume 10, price going at 5. Earlier it was average market price earning ratio was PE ratio was around 13 times. So you have to spend 13 years to get your return or market price of the share PE ratio. Nowadays, if you look at about the banks, their earning per share and the market price, their PE ratio, most of the banks, their PE ratio is less than 1. Less than 1. Generally, the accepted market now it is around 8 times or 9 times. If it is less than 1, mean it is a good investment to take. But if you are motivated with the dividends, recently government has imposed a limit to the banks. You can't distribute dividends. Right, that's why it has been fallen so much. Dividend cover earning per share. You can look at what is the dividend cover ratio, net asset per share, net asset divided by number of shares, return on equity holders fund. Right. These are the important ratios you can work out. But when it comes to the CHL, what has happened? CHL has a 0 dividend ratio. They have recently followed it up. Right. You can look at those investor ratios as well. Modes of business valuation. There are different modes of business valuation. It might be either net asset value based valuation. How can you do the valuations? Net assets, you will calculate net assets and you can calculate the value of a share. Okay, I'll come to. Remember, this is a historic basis valuation. Because based on the historical performance, you will calculate the net asset at the moment. Remember, it does not reflect. Okay, it does not reflect the future earning power of the company. It won't reflect. It just reflect what you have done in the past, not what you are going to do in the future. The intangible assets should be excluded from the valuation of net assets. There might be some intangible. When we come to net asset based valuation, you have to remove intangible asset. The net asset value highly depend on the assumption used in valuation of property. The changes in PP value significantly affect the value of enterprise. Right. At the determination of net asset, fair value of the net assets, at the time of acquisition, you might have to do the valuation of your fixed asset, PPE. Then the changes in fair value, it will add to the net assets. Assume if the assets being appreciated, your net asset value will go up. If the asset being impaired or there are some indication that assets being impaired, the net asset value will be fallen below the book value of the net assets. There was significant judgment involved, and you have to do independent valuation and see the value of net assets. Based on that, you can do the valuation. The next one is earning based valuation. Then you can calculate, that is PE based valuation, price earning ratio based valuation. Then you can determine what is the market price of the share. Okay, the highest business valuation is usually by the valuing the earnings under new ownership. This method uses the price earning ratio, which shows the stock market's view of the growth prospects of a company. And if you know the earning per share, if you know the price earning ratio, right, then market price divide market value divide by earning per share, then PE ratio will be there. Then PE ratio into earning per share, easily you can calculate market capitalization, market value per share. That is the one good method to do the valuation. What is the PE ratio? Price earning ratio. Then price earning ratio into earning per share. Then you will receive the market price. Right. Product ladder in similar instances, most of the instances, this earning based valuation is applicable if it is a listed entity, because it available earning per share, it will be available uh, market or market value, market traded price, then you can easily calculate the PE ratio. Clear? This is earning based valuation. When you calculating earning per share, that is the profit attributable to equity holders. That is profit after tax, right? Profit after tax. It has to be considered when determining earning basis valuation. This is a dividend growth model. This similar thing will apply into the free cash flow basis valuation. Can you remember P0, the price today, market value excluding any dividend currently payable, P0, ex dividend price, D0 into 1 plus G. Dividend D0 mean current year's dividend we have already received. D0 plus 1 plus G. What is the expectation of dividend growth? Okay. Then KE minus G, KE minus growth rate, then you can easily calculate market price of a share. Okay, this similar model, the dividend growth model, is applied when we are going to determine the free cash flow basis valuation as well. Instead of D0, we using free cash flow into 1 plus G, then WACC minus G. This is the earning based valuation of a share. This shows that earning potentials of the company, whether this company is able to generate sufficient return, right? Whether it is possible to earn some return and expectation. Based on that, you can calculate the earning basis valuation, or what is the value of a share. Again, in the free cash flow basis valuation, you have to take the operating cash flow, revenue minus operating cost plus depreciation, because depreciation is not a cash flow. Depreciation you have to add back, and debt prepayment and lease obligation you have to deduct, working capital increases you have to deduct, taxes you have to deduct, any replacement capital expenditure you have to incur, all are should be allocated. Then if the surplus exists, then you have to take the free cash, it's as a free cash flow. In the examination, most of the scenario, they will give the operating cash flow and operating profit. They have not cash flow. Then you have to make adjustment to depreciation and some tax payment. Once you've done the adjustment, then you can get the operating free cash flow. Based on that same apply using dividend growth model, you can calculate the present value of free cash flows. Right. Clear? I think it is clear, because most of the scenario, this earning based valuation also can be tested. It has been checked in previous instances as well. Okay, in the next one, we will move to the risk management aspect. Okay, why? Can you remember the things what we have discussed at the beginning? In the corporate finance and risk management section, contain two main topics and three subtopics. Simply three topics. Two main topics, and it will be split into three areas. First one, you have to evaluate proposals, options, and investments available to do the investment. Number two, you have to evaluate the suitable financing arrangement. Number three, you have to evaluate the risk associated with the entity or risk associated with the business or project. Therefore, there are different risks will be there in the market. You have to evaluate that and you have to make a decision. Okay, because now the environment what we are in is a very critical because yes, there are some comments just I have seen. Can you please share the note? The assumption that cost of equity and cost of equity. So general assumption is that cost of equity is greater than cost of debt. Can we use same assumption in this kind of crisis situation in Sri Lanka? In theoretically, cost of equity is the highest cost financing option. The reason is the debt has a tax shield. Tax shield means you can claim interest expense as a tax. The net impact you have to be considered. Right. That is the case, right? For liquidity ratio, the market value of debt should be considered. Yes, but some situation, most of the situation in the debt market, there's no debt market, because in the reason, if you look at about our market situation, mark to market, you have to do the mark to market and you have to calculate the market value of debt. In country like Sri Lanka, debt market, debenture market, and those debt instrument market is not much attractive or active. Right. Right. Yes, thank you. Right. I think if you have a question, you can put in the chat. I will go through and see. The strategic risk, this is directly affecting your cash flows, profits, and the growth of the business, because the strategic risk involved of the future direction of the company. You will acquire new business, you will merge, you will divest, right? There are different strategic decisions. That strategic decision severely or directly affect your cash flows, profit and all. Right. Significant strategic include concentration of resources, mergers, and acquisition and exit strategies. Recently, have you seen some mergers were happen? I can't remember the exact name. LOLC Finance, that means LOFC with another finance company. They have merged operation. The choice of suitable strategy has significant risk for the future operation of the company of the group. That means now this company CHL also is a group. By saying they have the subsidiaries, and the future decision will directly affect the company resources, company profitability, and the future direction of the company. It will be depend on the industry, economy, and the present actions of the competitor and your key competitive advantage, and other one is your skills, all affective strategic risk, right? It's strategic risk, the decision what you take and whatever the risk involved in your cash flows, profitability, and entire business direction, we call the strategic risk. Then operational risk. While reading this information, the operation I have seen few operational risk, right? Few operational risk I have seen. Then you can remember whether you have captured that one. Losses from internal control system or audit inadequacies, there were no sufficient information given. And also there is a failure of internal control system or inadequacies. Non-compliance with regulation, no internal procedures, I have seen somewhere else. You have to find it out. There are some non-compliances. There were. In this scenario also, they have been provided. You have to investigate it. You have to read it properly, read them properly, then you will understand it. Failures and inefficiency with information technology systems. No information given in the scenario because some situation where the information system may be ineffective. There's no proper linkage and there are some information leakage and there's no proper information flow. Then if your business operation doesn't have a proper information system, then there will be a lot of inefficiencies, deficiencies in the environment. Business interruptions. I haven't seen business interruption scenario in this scenario, but can you see in the hotel sector? There were so many interruptions because this COVID. Can you remember is the start from the attack in 2019 April, right? 19 April, then 1 year thereafter COVID till 2021. Then now economic crisis. There will be a lot of disruption. Then what will happen? What is the operational risk in the interruption to the business? While you are running a hotel, now there are continuous power cuts. How you run the business? Assume. Now you can look at about the external environment. How now due to the changes in fuel prices, due to the changes in food prices, now most of the hotels or restaurants have been closed down. Because it is a continuous interruption to their business, right? Power cuts, so many stores which need some electricity or power, then they have to disrupt the operation. They have to wait till the power comes again. There are a lot of disruption. Loss of key employees and human errors can be this situation. Also, there might be situations some directors are planning to leave the company. If there will be an operational risk, they will go and deal with or they can join with external competitor and the company secrets, some key advantages might be diverted to the competitors as well. There will be problems, yes, definitely. Frauds. This is the concept. It's regularly happening in the operation environment. You have to see that is there any opportunities that frauds can be happen. Now you are dealing with power generation, renewable energy. When you sell the product to the government or when to the national grid, what is the price? Sometimes price undercuts or overcharging and commissions. Those can be there in illegal manner. Damage to the reputation as a result of operation failure. Now assume now I don't know whether they have a reputation or not because since they have the monopoly, Litro. There was some incidents. That is the we call initial case. There was some blast all over the country, right? Then there was a bad reputation. That means they are not safe. Subsequently, now you can't see anything. Even you can't see any gasoline there. Right. That is the situation. There will be a reputational damage as a result of operational failure. Now they said they couldn't release the new vessel. Then you don't. They asked to don't wait in the queues. Right. Production and supply of inferior or poor quality product. What I have said earlier. If you supply quality failure or inferior product, definitely your reputation will be damaged. Use of outdated technology, but there's no indication here. If you use new technology, definitely you will get the competitive advantage. Those are the day-to-day business. The risk may arise from the day-to-day business operation. The procedures and policies should be aligned to uh, capture those inefficiencies or failures. Then you can run the operation smoothly. Right. Financial risk management, financial risk, different components are there under financial risk: financing risk, credit risk, exchange rate risk, interest rate risk. Those are sub risk in the financial risk. Financing risk. Okay, now you can assess in CHL, you can assess the mega. I can't explain in detail, but you have to assess your own. Uh, what is the current situation of the company? Whether they are overborrowed, whether they have already fully utilized the funds of the bank facilities, that means they have a financing risk. But you have already utilized the long-term financing sources and no short-term financing, you have borrowed at the maximum, then you have a financial risk. Now, Sri Lanka already borrowed more funds and there's no sources to borrow more. That's why we are short sort of forex. Right, you have borrowed excessively. If you borrowed excessively, there will be heavy burden to the profit or loss. On the other hand, you will run out of cash since you have already utilized your financing sources. That is the risk. Right now, when if you are not paying, like assume you are not paying to China, China may ask collateral or ask to redeem the collaterals to them. Right, they might ask, okay, India may ask, you have not paid, you are not able to pay, then give us the Matale airport, right? Or give us the Jaffna airport. They can demand, right? Same thing happened to the business entity. If they have borrowed already, if they are unable to pay, then banks may demand over the asset. They might ask you need to give the asset back to the finance institution. That is called financing risk. Simply financing risk means you are unable, you have already utilized the available facilities and it is difficult to obtain new banking facilities, and equity financing option also might be very tough and very difficult if you don't have sufficient equity infusion, right? They are not capable of infuse new equity. In liquidity risk, you can evaluate liquidity, current asset minus current liability. You can see whether current asset is sufficient to pay current liabilities, right? You have to evaluate the situation and see whether CHL or whatever the company, whether they are operating at a higher liquidity risk or not, right? Then bank OD facilities might have been overdrawn. Sometimes if you have taken the money to invest in long-term asset through the short-term borrowing, you will face difficult situation. You will face uh, disruption to the operation as well if you don't have sufficient working capital. Remember, if you don't have sufficient working capital, it will disrupt your day-to-day operation. Liquidity risk you can evaluate while calculating current ratio and quick ratio. Then you can get an idea. In the liquidity risk, if you have assumed if your current ratio is greater than 2 times of the liability, that means your liquid risk is very low. But if your current asset is lower than current liability, it is a one criteria for insolvency, then you will face some operational difficulties. Cash flow risk. The variability of cash flows directly affect the company operation. Sometimes you might have given power supply to the CEP, then they have given 1 month credit period, but they have not paid over last 6 months. Then if they have not paid properly, you have to see the trade debtors and all. Then you will not receive the cash on time and you may not be able to pay your suppliers on time. Then it will affect the supplier relationships and you might face liquidity problem as well, because cash flow risk means you might have given on credit, but they may unable to pay on time. If that variation will affect the cash flow position of the company. Credit risk. Credit risk, as I have mentioned, when you have given on credit, whether you can collect them without any default. Okay. Now, in this situation, there's a highly, now if you're sending to sell the renewable energy, or you are infusing to the national power grid, there will be some uh, delay in payments. Then there might be four probable defaults. Then you have to see how to eliminate that situation. Sometimes you might have take the insurance, sometimes you might have take bank guarantees, and there's a credit risk if you sell on credit. Then other is market risk involved, which we need to discuss. Market risk mainly involved with the interest rate changes. Now look at about the current market condition. Interest rate changes highly volatile. Okay, one student has shared me the details of the AWPLR and government securities. In January, right? In January, 3-year bond traded at 11.05 and 6-year bond at 11.7. In 2022, April 18th April 2022, 6-year bond previously traded at 11.7. After 3 months time, it has traded to 20.21. Right. There is a higher rate. 6-year bond traded at 20.21. The higher rate, right? Treasury bill rate also went up to 24.36 as at April. These are the recent trends. Interest rate changes highly impact on the financial liabilities, and it will heavily impact on your profit or loss statement. Highly exposed, highly exposed. It is a kind of risk which you can mitigate. Interest rate changes, if you have obtained a fixed loan at a fixed rate, then you can minimize the risk. But if you borrow it at a variable rate, in this scenario, you might have to pay AWPLR plus premium around 2-3. Then you have to borrow around 24-25%. The change in exchange rate movement, it was went up to, as I can remember, 385, 390, close to 400. Now it is trading at 365. Therefore, exchange rate changes also impact on the increase of inflation as well. Right. If you have taken some, if we say about like this, in the current business environment of Centric Holding CHL, are there any exposure related to the exchange rate? You have to see, because there are many hydropower plant and they plan to go overseas as well. The depreciation may affect the import product will go up, prices will of the import product will go up, but the given scenario you have to see whether it is applicable to risk. Okay, that is the basic understanding about the corporate finance and risk management aspect. Patience.
So you on mute.
Sorry. If any question, you can raise any question. Now we need to move into discussion of the pre-seeing, some applicable area. I think you have already gone through the pre-seeing analysis yesterday. Then I will roughly catch up some points and give you some ideas which will helpful for you. Do we need the break or shall we continue? Aruna? Aruna, shall I continue or they need the break? A few minutes break is good. Okay, Aruna, shall we take now it is 11:04, so 10:40. Shall we take 10-minute break? We'll have a 10-minute break. Yeah, 10-minute break, 10:50, we will start again. Okay. You guys, shall we start the session? Right. Hope everyone is back. We will start the session now. Now I will relate some information on the in what you have already discussed yesterday, and I will give some hints. That means I will give some idea. I will give some direction, but you have to work hard because these are just guidance, and you need to discuss or analyze in detail because it will take at least minimum 10 hours to dig in the financial details and then get an idea, uh, and based on that what we can predict. Okay, Centric Holdings Limited, that is the uh, company which we are going to discuss. Now you can see the background information. I will simply say, I will simply summarize the content, then you can get an idea. Uh, the Centric Holding, the chairman is Don Gomez, a co-founder. He has founded this company together with his father, Don Topash. Those have built up this Centric Holding, and his father Don Topash is a mechanical engineer. He was a chief engineer in the hydropower plant also, and he has a 28 years of experience. When CHL being formed in 1992, they were entered into renewable energy sector, and they have acquired the small hydropower plant, which was run by Kandekama family. Then thereafter in 1991, they have acquired the Centric Holding Limited CHL Incorporated, that means listed as a private limited company. Remember, this is a private limited company. They have incorporated as a private limited company in 1999. The shareholding structure, I think you have already discussed. 55% held by the Gomez family, that is Don Gomez and Don Topaz, and balance 45% goes to the Kandekama family. Then you have analyzed the Kandekama family, how the shares being distributed, that it has been allocated among the 4 members of Kandekama family. As I can remember, Nuan, Dr. Sharma, Devni, and Sanat. Those are the 4 individuals. One person, as I can remember, Nuan has given 15%, other 3 siblings got 10% each. That is the current shareholding structure. I think you have written down somewhere else. CHL has started wind power project in 2011 in Kandakulia on the west coast of Kalpitia. They are look at about they have the mini hydropower plant, that is one they have already done, and they have started the wind power project in Kalpitia, coast region in Kalpitia. Therefore, they are into their industry segment. If you looked at about their industry segment is renewable energy. Therefore, you can get some idea to read, to get an understanding. You can get some information from a power plant company called Valuable Power Ratna. You can refer that annual report, and then you can get some information, insightful information about the renewable energy. And the background of the renewable energy, if I have gone through, the renewable energy segment in Sri Lanka has not much focused on. There are some issues. One is there are some mafia, I will say mafia because there might be some commission from the uh, other power sources like diesel, uh, they are using coal power generation. Likewise, there might be some, if I say, uh, internal control of the failure of internal control of country, that there's no governance, there's no discipline. That's why what we are experiencing now. Because renewable energy, the green energy or clean energy is required, most of the countries is focusing. Why we can't do it? Because we can do it. Even most of the European countries now, they adapted solar power generation. China also, they have done a massive project. Then why we can't do it? Why we have never tried to that? Because the clean energy, the green energy is a key of a nation, because we can't sustain on fossil fuel, right? Because majority of diesel consumption have been allocated to power generation. Okay, fossil fuel, again, it used to generation of electricity, kind of a huge waste, right? Therefore, if you move into renewable energy, the damage to the natural environment will be minimized. It will be zero. Okay. Therefore, if you move into the renewable energy, then it will create more sustainable environment and sustainable energy generation to the nation. Therefore, CHL, in the perspective, CHL is in a very attractive and growing industry in the Sri Lanka at the present. Now, there was some amendment bills recently passed by the parliament relating to Electricity Act to give some, but there are some deficiencies because they have ignored the competitive bidding. That was the main weakness. If it is given the competitive bidding, both satisfied, because it is a renewable energy, competitive bidding both will be satisfied, then uh, it will be a great initiative and it will be an encouraging option. Now we have targeted 35% of power generation through renewable energy by 2035 or 2030. But other countries at that time, they are targeting on 100% renewable energy. Why can't we do that? Right. Okay. Now, if we go into the financial information, further I will explain. They are looking for an arrangement with solar power project, like kind of arrangement in solar power project, and other one is nuclear power plant. Uh, but some of the board members are not agreeable to that one. But there is an option, they can go into that and they can make an investment. Now CH is planning to going public while issuing shares at 50 rupees per share, and expected issue is 200 million shares. That means 200 million, that means 1 billion will be the total investment. No, total market capitalization will be 1 billion going to public issuing 50 shares for 1 billion investment. So 10 billion, right? Yes, 10 billion. Then he's going to list in Dirisavipur, the secondary board, and it's their public holding percentage, minimum public sharing percentage, then float adjusted market capitalization. You might know what is the floating float should be, how much they need to maintain, what is the number of percentage of shares issued should be available for trading purpose. That is the float adjusted market capitalization held by the general public. You have to refer some minimum IPO requirement. What is the IPO procedure? Why IPO? What is the benefit of IPO? You have to look at that aspect as well. So in general here, I am giving some indication, giving some direction. What are the areas you need to look at? Right. In addition, what you have to do, you have to evaluate each and every option and in detail see what are the areas you have to look at. The venture incorporating January 2011 for the purpose of Centric Wind Wings conduct fully private limited CWWK, and the plant was commissioned in July 2012. Right. This power plant, they have given some important information about this power plant. Guys, is it okay? I'm summarizing the content, right? I'm summarizing the entire pre-scene. Then some areas which may be helpful, you can write down your own notes. Okay. This CWWK, that centric wind wings conduct puller, is a private limited company. It was incorporated as a private limited company, and there's an investment company who has contributed to the equity of 33% of the company, and Mr. Gomez and I think Sharma holding 5% and 6% shareholding of that company, and balance holding by the CHL. That is arrangement. And before that means the company, the investor who hold 33%, they have invested for 10-year period. This is the things which I have gone through, which I can remember, what I can remember through the discussion or through the review of the pre-sale. And what was the agreement was they have commissioned in 2012, and the agreement was to operate 10-year period. Investment will be 10-year period of the before private limited. Then they have an option. They can ask to withdraw the investment. Then CHL has to purchase, or other option, extension if they requested, but it will be at the discretion of CHL. We don't have any clue about what will be happening, but most tendency they will withdraw the investment. Right. Company will pay back, CHL will pay back and take the equity holding. Then altogether 89% will be there in CHL. Right. Thereafter, they have established another project called, we can call it as a, I'm summarizing the content. Next one was the joint venture company. No, yes. Shining Grace. The Shining Grace is a solar power project that is again a renewable energy project. They are solar power project or solar power company. Shining Grace is the company they are going to promote. That is Shining Grace, incorporated Centric Shine Grace Private Limited, fully owned subsidiary. It's a fully owned subsidiary who do the solar power project. Remember, they are into renewable energy section, right? Thereafter, they are going for a joint venture. That joint venture, 72% from the foreign affiliates and 28% from the local institution, including 10% goes to the government and balance 18% goes to the two local firms in Sri Lanka. That particular project, they're targeting to power generation, electricity generation through the which call this is a hydro, not a hydro power plant. This is a called okay. In this one, there are three joint venture companies. That is 72% stake will be given. Synergy and OPEC and Power Bangi, those are the three investors. They are going to establish a consortium to commission or start the work for this power plant. This is a nuclear power. That's the word. Nuclear power plant. which we have never experienced. There's a new project, the nuclear power plant they are going to establish, and it will contribute to the national power generation. Therefore, uh, there's an interest. There will be some opportunities there to CHL to invest in nuclear power plant also. Why? Because they are experts and they don't have any idea about this one since they have never experienced it. And but they are in renewable energy segment. Okay, it's called related diversification, unrelated diversification. You will learn uh, through the discussion in future. Now they are going for that. They can consider it as also they have put that proposal, but there are some board members who didn't agree. On the other hand, if you look at about their board composition, uh, like it is a one-man show. Why all the most of the decision taken by Don Gomez, and some situation there were criticism that some decision being not being informed by the chairman, and they have, I think Sanat has mentioned that, not Sanat Gunatilaka, uh, Sanat Kandegam has mentioned that this has been not communicated, some decisions were not properly communicated, and there were some apologies when they are proposing establish CWWK, then wind farm, that is, which was established conductively, right? These are the Centric Holdings financial information. This financial information says about the revenue generated over the period. You can see that 3.4 billion revenue went up to 6.6 billion revenue over last 6 years, and cost of sales, GP margin, they have maintained. You can see while doing the vertical and horizontal analysis, you can realize what is the GP margin they have maintained. Other comprehensive income and expenses are there, other operating income and expenses. Administrative expenses, you can see there are some increase in some years and some decreases in 2021 as well. You have to see while we are doing some analysis, then you can identify what might be the reason of such significant variances. Finance expenses they have incurred, that means they have borrowed. Then tax expenses, look at relatively tax expenses in this year. This one is very much lower, but this one is very much higher, right? Therefore, significant variation in taxation you have to consider, because here you can see taxation is 248. The tax rate at another thing, applicable tax rate for renewable energy is 14%. Right. Then I have done the vertical analysis. In the vertical analysis, you can see in 2020, 2016, they have the GP margin of 41%, and it has gone up to 51% in 2021. Right. You can see the cost of sales ranging from 59 to 49. You can take the average as well. Other operating income, except in 2018, 17, 18, other some minor changes. But 2017 and 18, it has been significantly gone up. Administrative expenses. You can see it was closely, generally, these administrative expenses are um, fixed nature, most of the situation. 28, 26, that was at 28, 26, 26, 27, and 27. But suddenly it has dropped to 18%. You have to see what is the reason. Because the revenue has grown up. Why administrative expenses have gone down? This is something you need to care it about. Finance expenses, it range from 5 to 3%. Tax expenses also, they are 5 to 6%, and NP margin, sorry, yes, NP margin, 8%, 15, 32, 26, 6%, and 26. You can see how it has been changed over the period. 2016 to 2021, right? 2017, 2021, the change in NP ratio. Then you can get an idea why 2020, why GP margin fallen, right? Why NP margin has fallen? Because average around 40, 41, or close to 50, but it has been fallen in 38 in 2020. What is the specific reason? Then horizontal analysis.
So small question.
Yes.
So if you look at the P&L, the company is showing a profit for the 2016, 17 and 18. But when you look at the balance sheets, they are having return earnings, negative return earnings. That means accumulated loss. So if you look at the balance sheet, it is the accumulated loss is increasing whilst P&L shows a profit. How that's the relationship we consider here?
Yeah. Now first we will analyze the P&L when it comes. That's why while we are analyzing this information, then when we come to the balance sheet, I will explain what might be the possible reasons. Right? Got my point?
Okay. Okay, sir.
Sometimes you might be referred the accumulated loss in not the centric holding limited. It will be you might have been referring to other company, and I will show you this one because retained earnings, some situation it has been dropped. Sometimes you might have infused some capital. You can see 8 million, 8 million of 8 billion was the stated capital. It has gone up to 12 billion. Sometimes they might have done some right issue and capitalize part of the retained earnings there to the equity. Right, got my point? We will analyze when it comes to this point, we will analyze what might have been happened. Right. We are in vertical analysis we have done. Okay, now look at the behavior of the revenue. The revenue growth over the years, I have taken the average growth rate of 14% is there. And cost of sales, average growth rate 10%. And GP margin grown by 19%. Okay, GP margin 19% it has gone. This is the average, right? Now you can see there are some abnormalities, anomalies they are in between. Other operating income, it has gone up by 15% average. Admin expenses, they're generally gone up by 5%. There should not be significant changes. But in 2021, it has been reduced by 27%. You have to think about why is that. Finance expenses, the average increment rate is 2%. Tax expense 46%, profit or loss for the year. Then 46% average growth is there. 46% average growth rate. Then the ratios, if we have looked at the ratios, GP ratio, NP ratio, return on equity, and return on total asset, those information you can easily gather from the available information and see what is the indication. They are generating sufficient revenue and sufficient profit. You can even calculate uh, interest cover. You can look at whether interest cover ratio is captured, what is the how many times from the net profit before interest and tax, then look at about the interest cost, then what is the interest cover. You can see GP ratio. Previously, I have mentioned GP ratio, average growth is 19%, average. GP ratio 41%, 40, 57, 58, 38, 51. It has gone over the time, except 2020. Something has happened in 2020. Net profit ratio 8, 15, 6, and 26. This is the net profit ratio they have maintained. Return on equity 2%, 5%, 9%, 6%, 1 and 6. And return on total asset also vary from 1 to 5 and 8 also there. Right, now we will look at the financial position. Over the period, property, plant and equipment It has gone up from 18 billion to 30 billion, right? Property, plant and equipment, you might have bought some assets to generate hydropower plant, and those property, plant and equipment value cost 30.3 billion at the moment. There's a significant increase in property, plant and equipment over the period. Right of use asset, simply right of use asset, we according to SLFR 16, the leasing standard will apply right of use assets. Even sorry, lease property you have to consider is a right of use asset. Remember, it has gone up in 2018 2.3 billion, and now it came down for 31,839. Again, it goes up to 1.4 billion. Even you have taken the long-term lease agreement, it also coming under right of use assets, right? Intangible assets also there, but remember, intangible assets, you need to highlight why I am saying that. This one, significant increase in intangible assets are there, whether it is a goodwill it is an individual company, it won't be it should be there in the group. Then what is this intangible asset, right? What is the basic? Because here there's 102,590,000. There's no amortization. If it assume intangible asset is a computer software, it has to be amortized over the period, no? But it has not amortized. Whether they have test for impairment, you have look at, because it is 102,590. It's remains same amount, and it has suddenly go up in 2020 by how much? Look at the value, 997 million. Okay. 997,485 minus 102,590. It has gone up by 894.9 million. It has gone up. Then what is for that? What is the reason? What kind of intangible asset that belongs? Then investments, then 113, it reduced, and then here it ended up with 2 billion. The investment, Centric Holdings Limited, what are the investment they have made? Assume when they acquire Kandegama power plant and how they have recognized it, because they have initially paid that some amount, I can't remember the amount. They have paid, no, I can't remember, approximately around 140 or 54 million paid, the total consideration of 280 million. Then balance 45% of the equity allocated of Centric Holdings, right? Because what has happened to that investment? Because Kandakulia, it's not Kandakulia. This one we call Kandegam Power Plant, Kandegam Power Company. CHL has acquired. Then it should be an investment where it has been recorded. You have to recognize it. You have to think about it. And the company has invested in CWW Centric Wind Wings Limited, Kandakulia, where the investment being recognized and where you have recognized it. Now you can look at the current assets, 109 million went up to 556. We can look at current assets. Simply you can understand about the current liquidity situation. You can compare this current asset with current liabilities. Current assets are lower than current liabilities. That means you are suffering a net current liability situation. This is very critical. Current liability, current asset is lower. When it comes to here, look at current liabilities are 3.1 billion. 3.1 billion. Sometimes short-term borrow, you have more borrowed in short-term funds, right? Now here your current assets only 556 million. Then how can you settle your current liabilities, payables? Now you are running at a serious liquidity situation now, the liquidity problem. Sometimes you have borrowed and invest in long-term assets, right? Now when, as one student has raised the concern, now you have the profit 267.20, 1.8 billion. When the profit are there, your retained should goes up. 5.815 billion. Okay, then for 2017 profitability, what is this 2017 profitability? 720 million. If you add 720 million, then this value is tallied. Balan tally when check it will you 5,000, sorry, 5 billion 8,223. Add the profitability in 2017. Profitability in 2017. 720,092. It should be 6535315. Simply there's a difference 6535315. Sometimes there might be OCI component. Then it is 6535528. There's a small difference. That means no dividend being paid. It has been added to the retained earnings. That's you have agreed, no? Agreeable, yes. In 2018, what is the profitability? Profitability 1,899,810. It should be 8.4 billion. 8.4 billion, 8.4 billion 338 are deficit. Now it has been reduced by, but only available minus 4,435,338. Approximately 4 billion you have capitalized into the capital. Now the student who raised the question, now you have understood. Now you realized that. That means part of the retained earnings being capitalized into this one as the equity shares. Okay. Now, while you are analyzing that, I thought you have analyzed. Now, on the other component of, if we look at 625 went up to 5.1 billion. What is the reason? What is the reason? We have to think, because it has remained same in the other years, and this one also I couldn't highlight whether they are not depreciable assets. Then how it comes the same property, plant and equipment over the period? Those are some deficiencies while looking at, while analyzing this financial statement, which you can understand, which you can identify some drawbacks. There are some misconception, or sometimes it is not matched with the current trend. Then you have to see what is that, right? If you go back, then likewise you can reconcile the retained earning balance. The next 1.4 billion will be added. 4.4 plus 1.4 billion, it is 5.8. It's done. Then 5.69, 5.8 plus the profit of 357 million. If you add 357 million, then 357 million is a loss. No, 357 million is not a loss, but it has gone up by some amount, but not the same amount as earlier given. All right. And finally, it is 6.9. You have to reconcile. There's some deviation. You have to find out where are the deviation has happened. Then interest bearing borrowings. This one also highlighted. This one. A retirement benefit obligation, it will be changed over the period, but it has not much significant changes. And other liabilities, remember, the liabilities also grown up from 425,000 to this much. Significant improvement. That means liability have gone up significantly. Then you have to see what are the other liabilities contained. And these are the areas which you need to focus on, which you need to give more concentration. Why these such changes have happened? These are the vertical analysis. You can see important aspect goes to the property, plant and equipment. More than 90% given to the property, plant and equipment. And stated capital, other components of equity, retained earnings, and those are the vertical analysis. Important ratios, current asset ratio, you can see 0.4 to 0.5865. The liquidity position further deteriorated over the period. Gearing, debt divided by equity, I simply said debt to equity ratio. Debt to equity ratio is low, that means companies, low geared company, that means high equity, low debt. Net working capital I have given, sorry. Net working capital I have given, it is a negative net working capital. Current asset minus current liability. It is not good for a company because company will end up with liquidity problem and operations will be disrupted. Don't know whether you have borrowed the funds and invested in long-term assets. It will create a serious issue to the company. Then total asset turnover, it has been continuously maintained over a period. Those are the simple analyze, because there are some situations you need to go in detail and analyze. Like when you're going different hints are there in the pre-scene itself. It will take another 10 to 12, 15 hours to go in detail and predict what can be tested. We can't say exactly it will come, but you can imagine. Now you have to live in the pre-scene and then you can touch where it can test in the examination. That's why I said that you can get more information while you're having some small mini group discussion, because that was the strategy which I was followed throughout the history, because in the university I can remember we had some mini discussion. It was very fruitful and which was given more uh, insights, and no need to buy hard, because you can't buy hard this thing and you can write the exam. You have to get the understanding. Without understanding you can't attempt. Right. Now today's, as I remember, today's 11th or 12th. It's 12th. Now few more days are there. Simply it is 20 days. A kind of a 2020 match. Right. In the conclusive thought, the final, never ever lose hope. Right. Because we were very thrilled yesterday night, because I need to, while looking at this post, I thought I took it from ESPN, and because of this, sometimes you might think it is impossible. No, it is. I am possible. I can do it. It's a kind of a 2020 match. When it requires, you have, this is the required situation. You have to achieve. This is the final target you need to achieve. Even now you believe that, still you have not started. Now start itself. Future past failures does not matter. Even though you have failed so many times, but when you can rise like what Dasun Shanaka done yesterday, right? That because I'm very much family cricket fan. Uh, because I need to give some good thoughts as a conclusive thoughts, because we can do this target. You have need to give your commitment, right? If you give full commitment to achieve, because this is a big dream of your life, I'm telling you. Therefore, spend remaining 20 days very truthfully, then you can achieve this target. You can earn a title as ACA. There might be some student waiting for few more attempts. You first thing you need to do, your commitment is essential. You don't give up till last moment. Don't give up, right? And you have to believe yourself and you have to work hard. Have a team discussion is very important, and do more analysis, because this is a kind of a run through of the pre-seen and related financial information. This is not sufficient, I'm telling you, and you need to do in detail analysis, and then you will get more insights. Because in my practice, when I'm dealing with the students, I will have some mini group discussion. I will give more focus to time, and I will take in their time and explain these are the areas you need to focus on. If you have done financial management 5 years back, now you have to recall the things you have learned. This is not difficult if you give your really commitment to achieve this one. Okay, thank you. That is the end of my presentation. Now, I would like to share some thoughts with you. And if you have any questions, you can tell me and we can share some thoughts. First, let me know while we are conducting this session, because within the given time period, we have conducted this session, whether it is fruitful, if you have get anything, because what I have done, because since I have read the entire thing, that's why I have quickly glanced through the pre-scene, because I have done it twice, then I have a fair understanding. I thought that you have more understanding than me, then you can come up with some ideas we can share. And when you are planning your studies, you have to see, because in my discussion also I have planned properly. We need to read it carefully and I get the insights given in the pre-seen information, have fruitful discussions, and write down your own answers. Not There was some criticism from the examiner also. The students have pre-prepared answers, and if they are unable to write the exam, when the unseen situation is different. Yes, definitely unseen situation will be different. You can predict and go, but you have to customize the situation based on the unseen. You can't write down the same answer as it is. You have to share structure of CWWK. That means you have not read it properly. I'm telling you, still I can remember CWWK. I will show you. Guys, you have what I have seen, you all are not reading. Okay, today also we are having a discussion with our student. We said that it is mandatory. You need to read. Okay, look at this one. I will highlight. Uh, the Kandapulya project was partnered by B4 Private Limited, which is contributed towards 33% of the equity. 33%, right? Before is an investment management company having equity and debt investment in many industrial sectors. The investment by Before in 2012 was for a period of 10 years only, or as extended by Before at the discretion of its board. In the event Before decide to dispose the equity of CWWK, CHL shall buy. CL has to buy. That is the agreement. CHL shall buy at the independent valuation. Additionally, Dr. Sharma subscribed for 5%. 5%, 33 plus 5, 38. Goma subscribed for 6%, 35, 38, 44. Then the balance will be CHL. Then 100 minus 44, then you can know what is the percentage of CHL. Then you can know the shareholding structure. Lamai, you have to analyze. You can't expect it from someone else. You have to analyze, you have to familiar with that. Okay. I think this is Nishankar has shared the information. CHL 56, 6% before 33, Dr. Sharma 5%. Right. It mean bonus issue. Yeah, that can be bonus issue. Is bonus issue, sorry, bonus issue. Any questions? Okay, I think hopefully you have get some insight from the today's discussion. I don't know whether it was fruitful or not. I need your generous feedback, whether you have got anything out of the discussion, whether you have familiarized with the content. I can't say Dr. Sharma resigned from CWWK and will she join with Vivo? We can't say. You have to predict what will happen because they have been kind of a family business. The conflict will start after some time. Okay, there might be some disruption, there might be some clashes future. We don't know. Any comments? Given the market is in Sri Lanka and rising interest rate, can we expect this IPO to be successful? It's very doubtful based on the market condition. Then you have to think about is this a good. If you have mentioned in the minimum subscription or minimum subscribed amount, then if it is not fulfilled, you may not be able to proceed with that. For that purpose, they have came up with different suggestions, and based on the current market situation, you might say this is not a good time to come to the market. The reason is based on current interest rate regime and the current situation like this. But since you have a good financial position, right? Financial position and financial strength and proven track record and higher profitability over the period. Sometimes investors may attract and investors might see the prospect of the industry. Those factors will impact on the success of an IPO. Assume you are a company which you are going to trade, assume hotel shares. It won't be very lucrative. It won't be very attractive. But the industry like power and energy, people might get feel, okay, this is a growing industry. This industry has a future. There's a high potential to earn. And if that in case, you will be successful. It depends on the criteria of with the industry you are in and the investor's perspective. Right. Any questions? Yes, theoretically cost of equity are uh, greater than cost of debt because since you are expecting higher, you are entitled for residual interest. Right, that can be assumed, yes. When you are leaving minus stake in a company, what will be the most suitable method to use minus stake valuation? Sometimes you have to base the net asset basis valuation will be there. Net asset basis valuation, based on that you can determine the value. Can you share the PowerPoint presentation? Okay, this is a summary, guys. I can share the summarized presentation because it should be discussion in this area will be more detailed and more than this one. Then you can have your own discussion. Risk-free rate considered to be highly quality bond rate due to the current debt issue is that any impact on high quality, it's generally the rates or risk-free rate in the for the computation purpose they may provide it. And if you have a high quality bond, when you can find the high quality bond, generally the market, the high quality bond rate will trade at around 11% to 13% rate will be there. There's no can that mean generally in the exam question itself they will provide. If it is not, you can take the information available in the CBSL site and take, and you can consider the bond rate if it is required. Right. Now I think this pre-scene also it was given some information relating to the bond rate they have taken. Based on the given information, you can work out they have taken 11.9. That is the bond traded at recent option is 11.9. Any questions? I didn't say that locally impossible. For debt high rate, sometimes it will be depend on the power of bargaining power of the company. You can because then you have decided this is suitable time to go for the investment. It depends. Then you can't take the overseas investment. CSC trading is not active, but you can't say it is not active. Have you ever seen it is inactive? Because trading was generally even 2 hours are given, 10:30 to 12:30, but trading volume are much higher. It's close to around turnover more exceed 1 billion, 2 billion, 3 billion. Not like 6 months ago, it is total manipulation of there, but trading is active. You can't say it is not active. Components of liability, generally gearing, we are taking the long-term liability. Interest-bearing borrowings you can consider as taking the different aspect. You can take the total borrowings or total debts when calculating gearing. Those are not questions to ask. Right? Any questions? Otherwise, IAM Club financial information data is given because they said that they are going to they have a plan to acquire IAM Club Farm Hotel. That's their information being given. You can analyze their profitability, their current situation. Then you can decide because they have done the SWOT analysis as well. Then you have to evaluate whether they are going to acquire this company, whether is it suitable. Sometimes you might have to give some idea because you have to evaluate their financial performance because they have an intention. While reading the pre-scene, you can see they have an intention to acquire or invest this particular company. So those are some aspects we need to go further and dig inside, and I can't give you thought because then it will be limited because you will be restricted to that particular area. Because I can give the insights and I can give the background information, and you have to predict why if it is happen like this, what will happen, whether we have a capacity to do that investment, whether it is financially feasible, technically feasible. Sometimes you have some question about now one student says that environmentally not suitable for the nuclear plant, but like country like Sri Lanka, but it will be financially viable. Are we the only country? You have to see what are the other countries who doing this particular uh, because qualitative and quantitative aspect both you have to look at that. Now in a nuclear power plant, you can establish it is in a very remote area which uh, community spread is very low. Okay, then because they are not going to build up a power plant like Chernobyl, they are going to establish a small power grid or power plant, a nuclear power plant. But if it is not properly and properly managed, then anyway it has a risk. Foreign funding is available for green project. How CEHL should look at on it? Yes, foreign funding also available. You can take the private equity investment also. You can attract because it is a green energy. Because for the green energy purpose, so many of concessionary investment funds are available. They can use to the private placement. You can do that because it is a green energy projects being given at a low interest rate. Right. Okay, then I think there's no any other question. Aruna, then shall we wind up the session then? They have given the background information, Lamai. Therefore, why they have given mean you have to analyze why it is given. Because they are going to invest in wind power project and solar capacity. This is a model solar city which projected by the company. The projected future developments given because sometimes we may be able to get some uh, in foreign investment for this, so those solar project and other wind farm project. Yes. Because now when you're going to achieve a renewable energy targets, then you have to build up new solar project and wind farms and other renewable energy sources like hydropower plant. You have to build up in order to get the renewable energy. Like fossil fuel energy already being used and it is very costly and very it is not very environment friendly. Then alternative source of power generation you have to undertake. That's why they have given the potential opportunities in the market. These are the requirements that can be arising in the future. Okay, then I think you have gathered whatever the information you required, and it, hope it was added some value to your discussion. Then thank you for joining. And Aruna, is Aruna there? Uh, okay. I think you all have got something out of the discussion. And thank you everyone who has joined. And this session, I think this session will be available. And work hard and focus on the studies. And read in detail, have mini group discussion, more focus on, then you can easily achieve this target. Yes, I will share the presentation with Aruna. Aruna will share it with you all. Okay, thank you for joining. I am not meeting again, and sometime you might find my notes as well somewhere else. And I will share this presentation with Aruna, and Aruna will share with you all. Thank you, and stay safe and do your study. You can pass this final hurdle. All the best. Thank you.